Right, thanks, Mark. Right, my name's Mike Brown, and I work with a company called ETfSA, Exchange Traded Fund in South Africa. And that does, guess what? Specialise in ETFs, which are index trackers, which is what we've been hearing about from Mark. So hopefully what I've got to say will move on the presentation and I can give you some ideas of how exactly you can invest in index trackers, invest in the JSE through exchange traded funds. Let's just look now, what are exchange traded funds or exchange traded products? ETPs or ETFs. They're securities, they're shares, they're traded in the JSE, just like any other company. So they're listed securities. On the JSE, you can see the ticker floating along outside there when you came in. They're just like normal shares. But the difference is that they give you access to a portfolio of shares or fund. That's why they're called exchange traded funds or exchange traded products. The product or the portfolio they give you is an index. And that's what you've just been hearing about, is an index. The index measures a whole portfolio of shares, and it typically is picked by the JSE or by whoever runs the index, and they pick the constituents of the index, and all an ETF does is it exactly tracks that index or that portfolio. So let's just unwrap that a little bit. This is the top 40 index. Mark was talking to you about the top 40, different types of top 40, but it's a pure top 40 index, the market cap top 40 index. And some of those who don't believe that I'm being true, there's 20 on the front page and there's 20 on the second page. So there's 40 companies. That's why it's called the top 40 index. There's 40 companies in the top 40 index. And what it does, it measures the performance of the top 40 companies on the Johannesburg Stock Exchange measured by size. And that's the actual top 40 companies, alphabetically. So we had on the previous page, we started with African Rainbow Minerals, or Patrice Motsepe's company, and we went all the way down through Anglo Platts, down to Investec, and now we go all the way down to Woolworths. So when you buy an ETF, you're buying an index, which means you buy one share, one ETF, and you own 40 shares. So that's a bargain about an ETF. I buy one security, but I actually own a portfolio of 40 companies. So that's where you're getting your bargain for an ETF. You actually own a whole portfolio of shares, and because you own a whole portfolio of shares, and those go from, as I say, for the blokes, you've got something like SAB Miller makes beer, so it's a great company. Down to the woman, you've got Woolworths, which sells food that my wife loves shopping at. Or if you want to go to a decent company like ShopRite, Checkers, you can buy shares in those as well. So you can buy shares in any of the top 40 companies, but by buying the ETF, you're getting ownership of all those 40 companies. And the ownership you get is this percentage. So for every ETF you buy, let's say the Satrix top 40 or the RMB, the First Rand top 40, or the new funds, the ABSA top 40, 10% of your investment will be in SAB Miller, and 1% your investment in Woolworths, but you exactly replicate that index. So your ETF gives you ownership of an entire portfolio of shares. It also gives you the ownership of all the top companies in the stock market. So you're buying the best. You're buying the blue chip portfolio. And there's nothing that's going to go wrong with those top blue chip shares. There's no African Bank in there or Pinnacle or something like that. So you're buying a good portfolio of companies, and that's what an ETF is. Just gives you exposure to the index. As Mark explained to you, the index is calculated by the JSE. They do all the hard work. So the case for ETPs is you buy one exchange traded product or exchange traded fund, and you end up owning a whole portfolio of shares. But the bargain is you only pay once. No? That's nice. I'll go buy one pair of shoes and open the cupboard, there's 40 shoes in there. I mean, that's good for the girls. Or open the fridge, there's 40 different types of beer in there. But I've only paid once. That's what an ETF does. You pay once, you buy one security, but you're getting underlying ownership of an entire portfolio. So as I say, you buy one security and you own a whole basket of shares in the JSE. And that's what modern investment's all about. Modern investment is diversifying my risk. So I own a whole portfolio of shares. So some of them are going up and some are going down, but because I'm buying a quality portfolio, my diversification reduces my risk. For the mathematicians in the audience, your standard deviation or your volatility is reduced by having a whole portfolio of shares. And for those of you ladies who can understand a bargain, as I say, you're buying a whole box of chocolates. There's 40 different chocolates in there, and they're all yours. And so that's effectively what an ETF does. Well, the case for ETFs is that they're quite cheap because you're only paying brokerage once, but you're also having the cost of actually running an ETF. This is the domestic exchange traded funds, and there's about 40 of them in South Africa. they have an average cost of about 0.3% or 33 basis points, whereas if you look at unit trusts that do index tracking or unit trusts that do active management, you'll see the cost structures are significantly higher. So an ETF, because it's a simple product, has a low cost structure. And that's also good. Simple, low cost is good. The other thing that's quite important about ETFs is because they've already paid tax in buying the underlying portfolio, you don't have to pay it yourself. So when you buy shares, normally in the JSE, you pay securities transfer tax, which is effectively VAT for financial products. You don't pay with ETFs, which makes them also a bit of a bargain. And of course, they don't have the same amount of portfolio churn and so on. So from a cost point of view, ETFs are quite attractive. They're also good from performance. Those of you that read a lot of international stuff will find people like Warren Buffett and John Bogle, all these old blokes, Dr. William Sharpe, the Nobel Prize winner, all those. They say, listen, nobody can outperform a low-cost index tracker. You want to buy something, buy ETFs. That's what they say. And here's the proof. This is the South African market, and we're going back over 20 years, and this is as of June 2014. How many actively managed unit trusts? Actively managed unit trust is where the guys say we can outperform the market. We're smart. Coronation, we're Alan Gray, we're great guys, we're clever, we all drive Porsches and Ferraris, we're smarter than the market, we can outperform the market. What are the numbers? The numbers indicate that over a 20-year period, only 10% of all those active unit trust managers can outperform the market. And if you look at the interlying periods, on average 80% of all those unit trusts out there, and there's about 200 of them that track the all-share index, can outperform the index. So if you just buy an index tracker, you're going to beat 80% of the people out there. The other thing is that the people who do outperform the index, one year one bloke does it, the next year somebody else does it. You just have to look at the relative performance of Alan Gray against Coronation, against Old Mutual to see that they have good years and bad years. But when you buy the index, you're getting the average return of the market. That's all an index is. Index is the average return of the market. And the market's a collective wisdom of everybody who's buying and selling in that market. It's actually quite difficult to outperform that. You might think you're smart, but all those blokes trading every day, 20 billion rands worth of shares trading the JSE, they make the price. Markets are quite efficient, and all the knowledge about any companies in the share price. So that's the actual numbers. So when you're buying ETFs, they're cheap, they're simple, but they beat most things. These are the Toyota Corollas, eh? This is not the big sort of smart discovery that keeps breaking down every 5 minutes. These are the good, simple stuff that just goes out there and outperforms everybody because it's good, simple technology. And, of course, the arithmetic, the mathematics is on their side. So the case for ETPs, low cost, good diversification, good access to the market, good performance. Those are all the different companies that issue ETFs in South Africa. So you're going, they're mainly banks. ABSA, BNP Paribas is a French bank. Sanlam issues Satrix. You've all heard of Satrix, I think. Deutsche Bank, the DBX trackers, those are the companies that give you access to international markets. Standard Bank, Investec, Nedbank. They all issue ETFs. This is the total size of the market. Some people say the ETF market's quite small in South Africa. That's 101 billion rand. Total market cap of the ETFs in South Africa. It's growing massively, growing by about 30% per annum, has been doing now for the last 5 or 6 years. So that's the size of the industry, and they're all issued by big people, good banks. Even Grindrod Bank, small bank, I mean, that's a nice bank. Bidvest just about to buy it out. Bidvest is one of our biggest industrial companies. If you want to invest in ETFs, you can invest through etfSA in debit orders. You can't do a debit order through a broker, but you can do lump sums through a broker, or you can do debit orders or lump sums through etfSA. But let's just say you make an investment of 1,000 rand a month, and you're doing it in Satrix Indy, Satrix Industrial Index. The Industrial Index is the top 25 shares, industrial shares in South Africa, so there's no mining shares and no financial shares in there. Industrial shares means there's low volatility, because mining shares, you never know what's going to happen. It's going to be a strike tomorrow, or you're going to run out of ore, or whatever it is. And financial shares is always a crisis. So you take away the risk of financial and mining shares, you just invest in industrial shares. If you invested 1,000 rand a month, these are actual numbers. Because Satrix Indy has now been listed for 10 years, so we can actually go back over the last 10 years. So this is historical, this is history. But history repeats itself, if I remember my history from school. Most of you have been in school much more recently than I am, so you'll remember that. 1,000 rand a month, after a year is worth 13,640 rand. After 3 years, 57,000 rand, 124,000 rand after 5 years. To 10 years, that's 400,000 rand. just putting a bit of money away every month. So stop going to the bottle store, that Virgin Active gym that you don't use. Stick it into ETFs, $1,000 a month. After 10 years, because you now got 400,000 rands worth of capital working for you, after 20 years, 4.6 million. Based on historic performance numbers. The secret to investment, as you read more and more, is longevity. Stay invested. It's not how you time the market, it's how much time you spend in the market. You'll hear that. And buy low-cost products and simple products. You want to have 4.6 million rand and boot the hubby out in 20 years' time, just put 1,000 rand a month into Satrix Indy. And just keep on doing it. Because over time, you're going to be able to afford more than 1,000 rand. So if you're going to just buy one ETF, that's what you do. Buy it, stick with it, and keep there. Because that industrial index will change over time. New companies will join it, old companies will fall out, but you'll always be in that index. And the index manager will make sure that you're in that index. And Mark will make sure that the index is always the best companies. So you've got the JSE looking after you, and you've got the issuer. Now let's say you want to be more complicated. Because you're a bloke. Blokes like to complicate things. Women don't. All right. So blokes say, all right, I don't want to just buy one ETF. I want to buy a whole portfolio of ETFs. So I want to buy something in the domestic South African market. I want to buy something that gives me access to the international markets. The Deutsche Bank, it's the biggest bank in Europe. They list on the JSE what they call the Morgan Stanley CI, Morgan Stanley Composite Index, USA ETF. That means you own the top 600 companies in America. That's what this MSCI 600 is. You own a little bit of the top 600 companies in America, from Google all the way down. Microsoft all the way down. So you put 300 rand a month and that 300 rand a month into the Satrix Indy. I want to diversify, so let me buy a property ETF. Property is a very good long-term asset class because it pays high yields, and of course the value of property goes up over time. And I want to be in something very safe, so I'll buy a government bond. So I'll buy inflation-linked bonds issued by the South African government. So I've now spread my 300 rand amongst 4 different ETFs. Now you can do that etfSA. You give us 1,200 rand a month and we'll split it amongst 4 different or 10 different ETFs, whatever you want. Minimum is 300 rand per ETF. But let's just look at how that grows. And so with a fully balanced portfolio, so you're not putting all your eggs into just one basket, you're putting into different asset classes, different countries, and different types of investments. You're never going to lose money on inflation-linked bonds. This is a very safe long-term investment. And here you've got some diversification. You're buying global shares as well as local shares. You can run a balanced portfolio without a lot of money. And that performance, and I'll show you the performance just now of balanced portfolios, is equal to anything that you can get in the South African market. So once you get into ETFs, most of you, and I know from the etfSA platform, will buy more than one ETF. People don't just buy one ETF, they buy a whole stack of them. And that's why you can run your own portfolios. If you want to be more complex than that, or you want to put a bit more money in, let's say you're putting 1,000 rand a month in, like all you girls can afford that, 4,000 rand a month, then again, after 5 years, that's worth over 400,000 rand. That's quite quick. A lot of you are very young. You can get used to putting money away on a regular basis. It makes a hell of a difference. Big things in money, get invested, stay invested, persevere, preservation, keep the money there. You can take it out if you need because these are shares. You can sell them anytime you want, but don't sell them. Keep them there. And then watch the money grow. If you want to be more sophisticated, and I think the title was running portfolios, using ETFs, you can do what we call strategic asset allocation. Strategic asset allocation is where you say, I want to be in different types of asset classes at different sort of levels. And this is a very simple, typical asset allocation. And this is what you would use worldwide. And you can't go much wrong with this. If you put 40% into domestic shares, domestic equity market, the South African market, 30% offshore, and you put 30% into income-bearing assets. Income-bearing assets won't give you a lot of capital growth, but they won't fall. So this is your protection. And this is your growth in your domestic equity market, which is the best performing stock market almost worldwide in rands, in local currency. But I can also have some exposure overseas. And that's a typical asset allocation. That's a simple asset allocation. You can have something more complex than that, but that's all you really need to do over a long period of time. And if you go and buy a balanced unit trust or multi-asset unit trust, that's all they're doing. They're giving you an asset allocation such as that. If we run a portfolio on that, So now we're going to put 40% of our money into domestic equities. So we're going to buy the Indy, we're going to buy a financial index, we're going to buy an overall index using fundamental technology, buy a USA index, we buy the world fund, means we're now investing in shares right around the whole world. We invest in inflation-linked bonds and property, and we allocate that 100% of our money allocated in different percentages. And this is an investment. We don't put a number in here, but that investment over 3 years will give you 24% per annum return, and over 5 years about 21% per annum return, and that'll give you the numbers that I showed you earlier. But what's interesting here is that you can go and buy multi-asset unit trusts, the different types, low equity funds, high equity funds, flexible funds, and there's about 200 of them here. The average unit trust will give you 11% per annum against 24%. That's a massive difference. You show that to international guys, they say, what the hell is wrong with South Africa? What's wrong with your business? And the problem in South Africa is the costs are too high. Our unit trust industry has massive, massive costs. And you can see it. They all live in the smartest buildings in South Africa. They all advertise on TV. They've sponsored Grey's Anatomy and all the rest. They're not low-cost producers. They're high-cost. They all employ thousands of salesmen out there. I've had 2 guys phone me this month from asset managers saying, oh, we wanted to come and sell you some investments. They don't sell investments on telephone, but they're doing it. These aren't small companies. These are serious companies. These are 2 of the biggest asset managers. They're desperate for business. So they're spending a fortune in advertising. And that's why their performance is so bad once you take the costs off. Even if you take the flexible unit trusts, these are guys who can invest in anything. And so they don't really use the fairly safe asset allocation we've got, significantly underperform using a portfolio of index trackers. So you can do your own portfolio, or you can come to the various courses we give where we take you through what we call master classes in portfolio management. We'll teach you how to do that. Or just get hold of me and we'll run a portfolio that suits your particular requirements. But to do that, we've got to run a financial needs analysis on you so we know what your financial requirements, needs, and all the rest and so on are. But you can run portfolios using ETFs because there are now a lot of ETFs and there's lots of different indices that you can cover. Now, you can buy ETFs through any stockbroker, as Mark said, or using etfSA as a specialized platform, the only platform that you can buy all the ETFs through, all 70 of them on South Africa. And we'll accept investments from R1,000 lump sum. If you go to a stockbroker and you say, I want to invest R1,000, he'll kick you out the door. He won't even let you in the front door. Or you can do R300 a month, debit orders for ETF. So we'll take debit orders. We automatically invest your dividends 4 times a year. So dividends you get paid out every 4 months. It's like interest every 3 months. And we reinvest that because a big part of your performance in any long-term investment is reinvesting, capitalizing your income. Capitalizing dividends is a big part of long-term performance. We'll charge you an admin fee, depending on the size of the investment, from 0.4% up to 0.7%. So on a R1,000 investment, we'll charge you R7 a year. That's what 0.7% is. Over 12 months. Not up front, not every month, R7 over 12 months. That's what 0.7% is. That covers all your transaction costs, covers all your client administration. We'll send you tax certificates. We'll send you statements. You get access to your account online, whatever have you. That's all run through that particular administration fee. We have a brokerage charge because we've got to buy the shares through the JSE, but we do it at 0.1%. So on a R1,000 investment, it costs you R1 to do the stock brokerage. I'll talk about costs with brokers just now. We facilitate third-party investments, which is a very important part of investments. Open an investment in the name of your children, grandchildren, your mother-in-law if you hate her or whatever it is. Or, maybe she'll leave home and she'll go and take her investments and go and live somewhere else. But your third-party investment means you make an investment on a third party. And that's legal. You can do that, provided you've got to go through the right requirements for FICA documentation. We have a lot of investor clubs and stockfells investing now in ETFs. There's some of them here tonight. We only specialize in ETFs, and we can give you financial advice, and we'll do that within that same cost, provided it's not too onerous. If there's a lot of work involved, then we'll give you a charge for the financial advice. So you don't have to be rich. It isn't going to cost you a fortune to invest in index tracking ETFs, and it's within the range of anybody and everybody, including everybody sitting here in the audience. A lot of you already are in ETFs. Just to give you an indication of costs, if you do and I've got nothing against stockbrokers because I'm a stockbroker myself. You know, I've been registered as a stockbroker for the last 35 years. they charge a minimum charge per transaction, or they have a minimum fee. So let's say I was going to invest 5,000 Rand a month, debit order in 5 different ETFs. The stockbroker would charge me 50 Rand per trade for 5 different trades. That's 250 Rand a month. Plus he's got a settlement charge. He has to pay the JSE at 12 Rand 45 per transaction. And he has an admin fee of 60 Rand a month. This is Standard Online, which is the cheapest online broker. And that's going to cost you 372 Rand a month. If you do it through etfSA, we charge you 0.1% brokerage, which on 5,000 Rand is 5 Rand. We have a debit order charge of 350, which covers all that debit order, mixing amongst the different charges. And the admin fee of 0.7% per annum is 35 Rand a year. So over a period of a month, and it was 35 cents over a month, it's 43 Rand 50 a month, and over a year, 300 Rand for the year to do that transaction, 4,500 Rand to do through a stockbroker. So stockbrokers are not really designed for small, regular investors. They're there for the big guy who wants to buy a couple of shares, hold on to them, doesn't bother about reinvesting his dividends, doesn't want to switch, doesn't want to do debit orders. You can't do debit orders through stockbroker because they're not members of the SWIFT banking system, which we are as a facilitator. And so the costs of doing ETFs through platforms like etfSA are significantly lower than anything else. There's also the Satrix investment plan, and I think Deutsche Bank's got an investment plan, but you can only buy their products. So you can only buy the 5 or 6 Satrix products through Satrix investment plan, whereas through etfSA you can buy Satrix or Deutsche or any of the other products at the same price. So there's no difference in price. And that's all I'm going to say tonight. The contact details are there. Our website, we've got a separate website for our retirement annuity fund. There's a call center. We'll get hold of Jenny Lee Naidu, who's in the background there, and ask her to any questions you've got. We've given you packs, which have got a lot of material in them, application forms and things like that. Have a chat to us afterwards. But it's quite simple to get involved in ETFs. And it's probably the best product to start with. And even if you're starting as an investor or you're well diversified investor and sophisticated, more and more investors are saying, I also want to have ETFs as part of my portfolios. And ETFs can accommodate both first-time investors and sophisticated investors. Let's leave it at that and let's do questions. I see Waldemar's here to run the show, Master of Ceremonies. Thanks, Waldemar.